With speculation still circulating that the cash ISA allowance could be cut later this year, let's have a look at what options and workarounds you have if you still want to hold cash in your portfolio tax-free. Now, I'm not trying to encourage you to hold more cash in your portfolio than you need to. If you're holding for the long term and it's not an emergency fund, then the money should be put to work in the stock market. But there are a couple of scenarios where we may want to hold cash in our portfolio. It could be that we're looking to make a purchase in the near future and we want to take some of our profits from the stock market and secure it in cash. It could also be that we just want to utilize the ISA allowance in the short term because we're not quite ready to make an investment decision. So if we're coming up to the end of the tax year, we want to make sure we can get that money in that tax year to make use of that allowance before then making an investment decision. And right now, if we wanted to take profit in the stock market and we wanted to transfer that to cash, we could simply do a transfer from our stocks and shares ISA to our cash ISA because the allowances are exactly the same. But if this change comes into effect where they're looking to reduce the amount you can put into a cash ISA each year while still keeping the stocks and shares ISA allowance the same, then there's going to have to be restrictions on those transfers between a stocks and shares ISA and a cash ISA. This is actually how it used to be before it changed in 2014. For a long period of time, the total you could put into an ISA was £7,000. You could put all of that seven into a stocks and shares ISA, but you could only put 3,000 into a cash ISA. And you were able to transfer a cash ISA to a stocks and shares ISA, but you weren't able to do the other way around. And that's, of course, to prevent people getting around those different allowances by investing into the stocks and shares ISA, transferring it straight away into a cash ISA. And if this change does come into effect, then I imagine that's the sort of level of restrictions that we're also going to get. So if you do want to secure your profits from the stock market and hold it as cash, you do have a couple of different options. The first and most straightforward is simply holding cash in your stocks and shares ISA. The main downside to this is simply the return that you usually get on cash held in the stocks and shares ISA. Let me illustrate by showing you the rates that Hargreaves Lansdown offer. They have a tiered system ranging from 1.75% up to 2.75%, depending on how much money you have in the account. But those rates of return are just ridiculous, especially when the Bank of England base rate is sitting at 4% and inflation is very similar to that as well. Now, if it's just for a very short period of time, say a couple of months, then that's not really the end of the world. And actually, that's the most straightforward because you can simply keep it in the same account. You can sell your investments and just hold it as cash until you're ready to do whatever you need to do with it. But it could be that you're saving for a deposit on a house and you might need that money, say, in 1 or 2 years' time. And because you've got still a fairly short time horizon, you will take on more risks by keeping that money in the stock market. So you might want to secure those profits and just keep that as cash. Then over a 2-year period, in real terms, you would actually be losing money because it's lower than the amount of inflation. So you do have another option in using another platform such as Trading 212 or Invest Engine. These offer much higher rates than Hargreaves Lansdown, but they do differ in how they offer that rate of return. Trading 212 currently have a rate of 4.05% on any cash held in their stocks and shares ISA. But the key difference is that it's actually secured by money market funds, which are actually defined by the FCA as an investment. The definition of a money market fund is that they're designed to provide a high level of stability and liquidity while also delivering a modest investment return that has the potential to exceed short-term cash deposits in a bank or a building society. In other words, they're a short-term, low-risk financial instrument that look to maintain a stable value. They do this by investing in cash or cash equivalents, very short-term debt. Could be treasuries or T-bills in the US, what we know as gilts in the UK. Could be certificates of deposit, could be commercial paper, super low risk stuff. And that's why there's a difference in that rate of return. And that's also reflected in Trading 212's cash ISA, which sits at 20 basis points less at 3.85%. And that cash you hold in their cash ISA is actually held as cash. And the short-term nature here is really key. When you're investing in any debt products, if it has a long time to maturity, then you do take on what's called duration risk. And this is where the value of that bond can vary in value as it matures or as it gets closer to maturity date. If you have a really short-term bond, then obviously you reduce that duration risk. And that's why it's really key with these money market funds, which are designed to be very stable, very liquid. They want to maintain their value over that period. You have very short-term duration risk. They also use what's known as qualifying money market funds, and these have to meet strict regulatory requirements, such as the weighted average maturity being 60 days or less and providing same-day or next-day settlement. And to highlight how stable they've been, two of the biggest players in the market, BlackRock and JP Morgan, their qualifying money market funds have been active for 30 years with a valuation of 100% throughout that entire time. And bear in mind, we've had massive stock market crashes in that period. And this is why pension funds, insurance firms, and banks use this to store cash for a short period of time. And that's how you should see this as well. This shouldn't be a 10-year plus holding period. This should be that 1 or 2 years where you're saving up for that big purchase like a house. If it's for something like an emergency fund, then of course, every tax year you can put that allowance into a cash ISA. So over time, you're going to build up that 6 months of expenses or whatever you need in your emergency fund. And anything longer term than that, if it's 5 year plus in terms of a time horizon, then that money should be put to work in the stock market anyway. If you wanted to, you could also pick your own money market fund, but of course, this is a little bit more complicated, and you're not going to get a fixed rate return like you would holding your money with trading 212. But just to give you an example, this is CSH2, which is a money market fund in the UK, and you will get a different rate of return because it will vary. But just to show you an example, over the last year, it's done 5.02%. Over 3 years, it's done 15.01%. But as you can see from the performance graph, it's very stable. You don't expect this to fluctuate whatsoever. It's very low volatility. But in my personal opinion, if you're wanting to take your profits from the stock market, you just want to have that guaranteed rate of return. Holding as cash in a stocks and shares ISA, such as Trading 212 or Invest Engine, is usually going to be your best bet. But if you want to avoid money markets altogether, you could also look at premium bonds. You can hold a total of £50,000 in premium bonds. The average return right now is currently around 3.6%, but that is the mean average return. And because it's based on prices, that will vary from time to time. But it is completely tax-free. The main difference to holding it in a cash ISA is that amount can't simply grow. So any money that you get from it is simply paid out in the form of cash. It doesn't grow over time and compound. So if this change does come into effect, it will get a lot of attention, and it has done already and hasn't even come into effect yet. And rightly so, it is a big change, but you shouldn't be too concerned. There's very specific and unique circumstances where this will cause you an issue. This doesn't affect any holdings you already have in a cash ISA. It is not going to come in straight away as well. So whenever it's announced, it's likely going to be in the next tax year. So you could prepare by putting that money in beforehand. And like we've discussed, if your time horizon is more than 5 years and is not for an emergency fund, then you should be putting that money to work in the stock market anyway. Let me know what you think of this as an idea of holding your cash in money market funds. Do you think this is still too risky being an investment? Or is this the most straightforward workaround? Let me know in the comments down below. If you do need any extra help in applying these ideas to your own situation or anything regarding your investment approach, I do offer one-to-one investment coaching calls, and you can find out more using the top link in the description below. Thanks for watching, guys. I hope you found that useful. Drop it a like if you enjoyed it, and I will catch you in the next one.